Right now, the UK government will pay you 5.7% a year, guaranteed for the next 28 years. That's more than any savings account, and unlike a savings account, that rate is fixed. So in this video, I'll show you exactly which government bonds pay what, how they compare to other products like savings accounts and annuities, and then look at whether now is actually a good time to buy them. The Bank of England has just held rates at 3.75% for the 5th consecutive time, and 3 out of 9 policy members even voted to increase it. At the start of the year, the expectation was 2 or 3 cuts this year, but after the conflict in the Middle East pushed up energy prices, the bank has been very wary of inflation increasing. At the same time, the government's borrowing costs have been creeping up to the point where the 10-year government bond was last seen this high back in 2008, and the 30-year bond hasn't been this high since 1998. But as much as this is to the detriment of the government, this could be to your gain. When the government wants to borrow money, they do this by issuing bonds, known as gilts. You lend them your money and they pay you interest twice a year, called a coupon. And on a fixed date, they give you the full face value back. The face value is always £100 per bond, but the price you'll pay for the bond will be dependent on a number of factors. Let me show you an example. This is a list of all the UK government bonds you can buy right now. Let's look at this one here with the ticker T46. This is a 20-year bond and it pays a coupon of 4.25%. It's currently priced just under £83. It's less than the face value of £100 because when this bond was issued, yields were lower. Because the bond has a fixed coupon of 4.25%, when yields go up, the bond becomes less valuable and the price drops. The coupon rate is based on the £100 face value, so because you're buying it for less, you'll see this one has a running yield of 5.1%, which is what you'd actually receive in income. So you'd pay £82.76 today, receive around £4.25 in income every year, which is 5.1% of your money, and at maturity, receive the £100 face value. The yield to maturity of 5.691% is your total return. It combines the interest you're paid with the built-in gain from being repaid at £100. What makes these different from most investments is that the day you buy, all of those payments are locked in, every coupon and the £100 at the end. You don't have to hold the bond to maturity either. You can sell it on the secondary market, but the price will move around depending on yields. So if yields go up and then you decide to sell, you could make a loss. Of course, it works the other way as well. But as long as you hold to the maturity date, none of that affects what you receive. One practical thing to be aware of is that the coupons are paid out to you as cash. They don't automatically compound like interest in a savings account does. If you want that 5.6% to compound, you'd need to reinvest the income at whatever rates are available at the time. Of course, if you'd rather just spend the income, that's fine too. Plenty of people buy bonds for exactly that reason. The yield curve shows you the yield to maturity on gilts plotted against how long you're lending for. At the moment, you'll get around 4.41% for lending over 2 years, about 4.6% at 5 years, 5.04% at 10 years, and somewhere between 5.69 to 5.77% once you're out at 20 to 30 years. On a typical yield curve like this, the short end mostly follows where markets expect the Bank of England base rate to head, while the long end pays extra because you're lending over decades and taking on that uncertainty. And right now, that long end is paying around the highest levels we've seen this century, which is potentially a big opportunity. A gilt held to its maturity date is one of the very few assets where you know exactly what the return you're getting before you put any money in. An easy access savings account will adjust its rate the second the Bank of England reduces its rate. Money market funds will also reprice almost immediately, and your return on the stock market could be anything. And if interest rates do get cut over the next few years, which is still the general expectation, even though nobody knows when, you keep your locked rate and the market value of your gilt would usually rise on top of it. So if you did need to sell before the maturity date, hopefully you're in the money. But that's just a long-term expectation. Donald may decide to start another war next year. Who knows? But here are the 4 situations that I think are primed for the use of gilts. The first is money you need on a known date within the next few years. A house deposit, for example, where you already know the stock market is too volatile for it. The fair comparison here is with a savings account. Right now, the top easy access accounts pay around 4.5% variable, and the best fixed rate accounts pay around 5% for both 3 and 5 year fixes. That compares to roughly 4.6% on a 5-year gilt, and the benefit with a savings account is that it compounds automatically. The downside with the easy access accounts is the variable rates, And with the fixed rates, your money is locked away, so you can't access it early. Plus, from next April, if you're under 65, you won't be able to transfer from a stocks and shares ISA to a cash ISA. So if you leave the money just held as cash, you're looking at closer to the 3.8% that Trading 212 offers. But it would actually end up being lower than that due to the new 22% tax on interest earned on cash in a stocks and shares ISA. Gilts are not being treated as cash-like assets. The second is matching a future liability. For example, say you're on a PCP car finance deal with an £8,000 balloon payment due in the summer of 2029, and you'd rather have that money dealt with now than hope it's there nearer the time. You could use T29K that matures on the 22nd of May 2029. It currently trades at £98.67, so for £8,000 face value, it will cost you around £7,900. But you'd get paid a yield of just over 4%, so about £320 a year. Whatever happens to markets or interest rates between now and then makes no difference, because you're holding it to maturity. So the amount and the date are both fixed. The same idea works for any bill with a specific date. You're turning a future liability into a holding with a guaranteed return. The third is bridging early retirement. If you want to stop work at 62 and your state pension doesn't start until 67, or you're going even earlier and you can't touch your personal pension until 57, there's a gap that needs filling, preferably with guaranteed income. A gilt ladder fills it year by year, with one gilt maturing just ahead of each year you need to fund. Say you need £20,000 a year across 2030, 2031 and 2032. You'd buy 3 gilts, one maturing in each year. For 2030, you could use TR29, which matures in October 2029 and would cost around £17,876 at today's prices. For 2031, TG30 matures in October 2030 and costs around £16,878. And for 2032, TG31 matures in July 2031, costing around £16,222. So around £51,000 today delivers £60,000 of spending money, with each instalment paid out a few months before the year it's covering, and some small coupons coming through along the way. All 3 of those are low coupon gilts, and that's deliberate for a ladder like this, because they pay very little interest while you hold them, and instead trade well below £100. So nearly all of your return arrives as the final amount on the day each one matures. At this stage, you're not looking for income from these, you're covering future costs on a known date. The fourth situation is retirement income itself, where the obvious comparison is an annuity. So let's put the actual numbers side by side. There's lots of variables for annuities, but let's say for a healthy 65-year-old today with £100,000, they can receive an annuity paying about £7,700 a year for life. T46, the 2046 gilt, with the same £100,000, pays around £5,135 a year for 20 years, and then returns just over £120,000 at the end. The annuity pays a higher percentage and it's guaranteed for life. The gilt gives you more flexibility, and you could also choose a different one, such as T56, which would pay you around £5,694 a year on the 100k. There's no right answer, it really just depends on your situation, but always compare. Gilts also have the benefit of being exempt from capital gains tax. So if you hold gilts outside of an ISA, while the coupons will still be taxed as interest, any gain in the value of the bond is completely tax-free. This is why the low coupon gilts we used as the retirement bridge earlier can be so popular, because there's barely any coupon to tax. Nearly all of the return comes through the bond maturing. There's a measure for what that's worth called the gross equivalent yield, which tells you the rate a normal taxable savings account would need to pay you to leave you with the same money after tax. For the gilt TG30, which has a yield to maturity of 4.471%, it works out at roughly 5.4% for a basic rate taxpayer and about 7.1% for a higher rate taxpayer. Inside an ISA or a SIP, none of this matters because everything's protected anyway. But if your ISA's full and you're holding cash in a general account, this is where gilts become hard to ignore. The main risk with holding gilts is not holding to maturity and yields increasing. This underpins almost everything we've talked about so far. You only get the guaranteed return if you hold the bond to maturity. You have the flexibility to sell the bond early if you need to, but you're at the mercy of the bond market. You may look at the 30-year yield being at a level not seen since 1998 and think it can't go much higher, but that's the active call you've got to make. And the longer dated the bond, the bigger those swings in price tend to be. 2022 was a horrible year for bonds. Inflation was already climbing as we came out of the COVID lockdowns, with all the stimulus meeting broken supply chains. Then Russia invaded Ukraine and sent energy prices through the roof, pushing UK inflation above 11% by the autumn. the highest for over 40 years. The Bank of England responded with the fastest run of rate hikes in decades, taking rates from basically 0 at the start of 2022 to 3.5% by the end of the year, and on to 5.25% the year after. Bond yields moved even quicker because markets price where rates are going rather than where they are. So the 10-year gilt went from about 1% at the start of the year to over 4% at its peak that autumn. And with prices moving in the opposite direction to yields, long-dated gilts lost a third or more of their value in a single year. Anyone in a bond fund took all of that with no maturity date coming to put it right, while anyone holding an individual gilt to its maturity would have just seen a temporary loss on paper. And that's the whole point of buying an individual gilt rather than a fund. If you hold to maturity, you don't have to worry about this risk at all. The other risk to a regular gilt is inflation, because a fixed coupon in 2056 is not going to buy what it buys today. But there's a version of gilts designed for exactly that problem. Index-linked gilts are the same product, but the payments grow with inflation. And the number to look at here is the real yield, which is the return on top of whatever inflation turns out to be. If you hold to maturity, the return is guaranteed in the same way. At the moment, the long-dated ones pay around RPI plus 2.5% for 20 years or more. If we take the TR46 gilt, you'll see it has a clean price of £62.85 and a dirty price of £101.32. The clean price has inflation stripped out, so different gilts can be compared, and the dirty price is what you'd pay, which includes the roughly 61% of inflation this one has already earned since it was issued. Buy it today at £101.32, hold it to March 2046, and if inflation averages 2% a year, you'll receive back roughly £238, which is about 4.6% a year. At 3% inflation, it's around £288, which is about 5.6% yield. That yield is the same as what a conventional 20-year gilt returns, which means around 3% inflation is the crossover point at which index-linked gilts pay more. The choice comes down to where you see inflation over the next 20 years. One small thing to be aware of, from 2030, the way RPI is calculated changes to match a slightly lower measure of inflation called CPIH. So for most of the life of these bonds, the inflation uplift will be based on that lower measure. But the market already prices this in. What index-linked gilts are not suitable for, though, is as income-paying investments. That's because, as you can see from the list, the coupons are extremely low, as nearly all of the return is built into the final repayment. Think of them as inflation-protected lump sums for a specific date. And this also makes them great for tax efficiency outside of an ISA, as most of the return will be from capital, which is tax-free. And if you're specifically after inflation-protected income, you might be better looking at an index-linked annuity instead. Buying them is fairly straightforward on most of the big platforms. Most of them charge a flat dealing fee. I'll put on screen a comparison between them. If you're buying a large amount, you'll barely notice dealing fees. It really only becomes an issue with small amounts. More of a decision is on the annual charges, which depends on what else you hold. By far the cheapest option is free trade because it's free on their basic plan, but the limitation is that they only offer 7 gilts currently. For the others, inside an ISA or a general investment account, Scottish Widows is the best option as there's no annual fee. And if you're already paying for Interactive Investor, that could also be a good option. There's no stamp duty on gilts, unlike shares, and the dealing unit is £1 of face value, so you don't need to buy in £100 blocks. It really comes down to what the money is for. If there's a specific liability or target, a gilt lets you lock in a rate today and gives you that peace of mind. Some people also just simply want part of their portfolio to be a known quantity that pays what it says, whatever the stock market is doing. If you've got cash sitting outside your ISA, you could benefit from the capital gains tax exemption for gilts, especially if you're a higher or an additional rate taxpayer. Where you need to be careful is using money that you might need back before the maturity date. It can work for or against you, but you're at the mercy of the market. And if you're accumulating with a long time horizon, even though the yields now are very good, they're still below the long-term average of equities. Everything I've quoted in this video is correct as of the time of recording, but prices and yields do change on a daily basis, so you'll most likely see a small difference when you watch this. If you want to see what creating an income in retirement actually looks like and the main options available to you, then watch this video next. I'll see you in the next one.